A super strong dollar. What's it actually mean, and what's the implications as investors, retirees, and just citizens of this great country of ours, plus some hidden surprises, if you will, in your higher Social Security that is expected for 2023. A little hidden toy surprise, maybe not a toy surprise, maybe a tax surprise, more appropriately, that we will be talking about on the program. So welcome, of course, to Dollars and Cents, where we help you make sense out of all of life decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout the Central Florida region here every Sunday morning. If it's not Sunday morning and you still want to listen to the program, well, then you've got to go to the internet, a la a podcast or YouTube video. Just follow us on your favorite podcast or social media platform of choice, and you'll see our videos and our audio of the program each and every week. Any problems finding us? Well, go to our website, Nelson Financial Planning. Go to the upper right-hand corner. You'll see the icons. Click on the one that looks most familiar to you. My name, of course, Joel Garris. I am a certified financial planner, certified financial fiduciary at Nelson Financial Planning. So I guess we'll start the program as we like to do in this first segment, kind of talking about the topics of the day, sort of the week that was. And I don't know you, but I think the message is loud and clear. The Federal Reserve is now fully committed to raising interest rates no matter what. And as you might well imagine, the market doesn't necessarily really like that message, right? This past week, the Federal Reserve raised interest rates by 0.75%, the third such increase in a row. Prior to those three, the last time you saw an interest rate increase of that magnitude was all the way back in like 1994. So certainly a pretty aggressive posturing, predominantly because they kind of were a little slow at the wheel by reacting to some of the inflation data that was coming out last week. But they're doing everything they can to make up for lost time. Of course, when you raise interest rates, what happens? Well, you drive up the cost of borrowing money, whether that's mortgages, whether that's construction costs, whether that's a corporation, if you're financing inventory or you're financing the construction of a building. All of those costs goes up. And I guess here's the interesting thing is the message that the Fed is giving and the market's interpretation of it. So I think in hindsight, clearly the markets may have misinterpreted the message this summer. If you look at what the markets did from mid-June to mid-August, roughly that 60-day period of time, there was actually an improvement in the overall market indexes by almost 17% in that 60-day period of time. I think the market was sort of over-anticipating, maybe the Fed doesn't have to raise rates as much. Ultimately, they might be able to cut them, if you will. The reality, of course, is that certainly is not the case. And since Powell's comments in Jackson Hole, Wyoming, at that fancy banker conference that's held every summer, where he talked about sort of the pain that may have to come, the markets have then sort of readjusted to that message and sort of unwound all of that recovery that we saw in those 60 days of the summer, basically putting the markets back to where they were around mid-June. So I guess the answer is that the message has in fact been delivered loud and clear, and the markets have responded accordingly. The reality is that higher interest rates are intended to reduce demand. That's what it is attempted to do, which is why you hear this conversation about, well, the only way to really kind of slay the inflation beast is to raise interest rates with the hope of reducing and bringing down demand. We got some interesting comments about the strong dollar and how that can actually help as well in this conversation. But there's not really, if you think about it, there's not a whole lot that the Federal Reserve can do on the supply side, right? Because they're not going to go out and start making iPhones or things like that. The reality is that the only way they can sort of tackle this is trying to fix the demand side of those supply of demand and supply economic concepts that come together to produce pricing that produces inflation and things like that. So I guess the question is, is there opportunity as investors? Is there opportunity as retirees? I mean, clearly, as with any business cycle, there's always going to be winners and losers, right? Companies that do well and companies that don't, companies that struggle when the going gets tough and others that sort of excel when the going gets tough. So there's always, I think I would encourage investors and retirees to not think of the market in terms of platitudes, right? I think obviously, if you're looking at the top line number of your balances, they're clearly down this year, but I think it's important to look at individual positions in your account. Because remember, you're not going to spend all of that money instantaneously on a random day in September, right? You saved all of that money over the course of a 20 or 30 year period of time generally, and so chances are you're probably going to spend it over that same 20 or 30 year period of time. So it's important to kind of, yes, I know people see the top line, and that creates obviously the greatest reaction, if you will, to what's going on. But I think it's important to look position by position in your portfolio. And at the end of the day, you should see positions that certainly should make up a decent chunk of your portfolio that maybe aren't down as much, right? Maybe you've got some positions that are down 25% or maybe even 30%, but then you should have other positions that are down kind of in the single digit range. And so if that's the case, then that's good because that means you've got a diversified portfolio. That also gives you flexibility, right? And if you need money, if you're taking income out of your portfolio, it's those investments or those positions that you can use to help generate out income, to help ultimately cover you in retirement so that you're not having to use the stuff that's down 25 or 30%. That's the notion of having a diversified portfolio. And I think now it really sort of underscores why it's so important, because if you've got a diversified portfolio, then you've got different things doing differently at different times. Right now, though, you should certainly have some stuff in the portfolio that maybe is only down single digits over the course of the past 12 months. And if that's the case, well, then that's where you go to ultimately utilize that. I think it's also an opportunity to think about really dollar cost averaging or sort of buying the dip, if you will, or at least to kind of start to think about that concept, because for those that are still working, still saving, I think there's a natural tendency to say, well, wait a minute, the market's not doing well, so I'm just going to stop making the contributions. And the studies and the statistics would say that that's not really a great idea. So when we come back from the break, we're going to kind of touch upon this idea of how best to invest in the current environment. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking a little bit about dollar cost averaging and thinking about that as a way that as an investor, you can maybe seek some opportunity, particularly in what's going on in the market today. Dollar cost averaging or even sort of buying the dip, both of those concepts are part of an Instagram video that one of our fellow folks at Nelson Financial Planning, Chet Cowart, did just this past week. So we encourage you to check out our Instagram channel. He is one of our paraplanners, and so he did a Instagram video about dollar cost averaging and sort of buying the dip, if you will. And then lo and behold, the Wall Street Journal had some interesting stats just this past week that we wanted to share with you on the program as well, that sort of underscores why it's important even if you have a flat market, because there's certainly times where you can have a flat market, and we'll give you sort of the two times over the course of the past 50 years where that has happened, and what ultimately the performance numbers are. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary, where Nelson Financial Planning, our team of certified financial fiduciary, stands ready this week to help you change your life with a successful and cost-effective financial plan. So here are the stats and the breakdown that the journal was doing, looking at periods of time where the market essentially goes nowhere, but yet if you're using a dollar cost averaging strategy, you can still wind up with a respectable rate of return over those periods. So it looked at the two periods over the course of the past 50 odd years where you've got a decade at least where the markets sort of meander and go sideways. So the first period was January 1968 to January of 1979. So about 11-year period of time. If you look at where the indexes were, S&P 500, Dow, all those kinds of things, not really changed from where they were in January of 68 to January of 1979. Similarly, we saw that relatively recently, although I guess it's not that recently anymore. It's pre-having kids, and they're now, 21. So anyway, January of 2000 to June of 2012. So that's about a 13-year period of time where if you look at the indexes and the level that they are at, there really wasn't any particular change. Very similar levels for the overall market indexes in January 2012 versus what we saw in January of 2000. But if you dollar cost average on a regular basis, which means that you're putting in a consistent amount of money every single month, well, then in the 68 to 79 period, your annualized return would have been about 5.2%. And in the January 2000 to January 2012 time, your return would have been 5.7%. You may say, well, wait a minute, that doesn't sound all that great. Well, if you're making 5 or 6%, that's still better than what you would traditionally expect on the bond side of things, and certainly on the cash side of things. So yes, the return may not be as good as we all like to think that the market's going to generate, but if at the end of the day it's still the better return out there over time, well then that still gets you to the same answer now, doesn't it? But the dollar cost averaging, particularly if you are in the accumulation phase, is a great strategy that ultimately, even in flat markets, produces returns that are much better than sort of the available alternative. So the reality is that we never know what's in the future. And when we look at the markets today and we see them down close to 25% since the beginning of the year, I think what comes to mind, and we talked with a couple of different clients this past week about sort of this concept, is that when something is on sale, right, by 25% off, I think as humans, we have a basic sort of desire to say, well, wait a minute, that's a shirt or that's a pair of sneakers that was X price and now it's 25% off. That's a great sale. I'm going to go and buy those sneakers or buy that shirt. And it's funny, when you think about money and opportunities to invest, for some reason, human nature doesn't sort of translate quite so easily to those T-shirts and sneakers as it would if it was investing money. My late father-in-law, Jack Nelson, who started the company Nelson Financial Planning back in 1984, used to tell it as a tuna fish story. And I'm by no stretch of the imagination going to do it justice on the program today, but I'm going to try and give it a little bit of a flavor, if you will. He had much more flavor in his stories. I will certainly give him credit for that. But so he tells the story of how his wife went shopping one day and comes home and he sees on the counter like 8 cans of tuna fish. And he looks at her and he says, why did you buy so much tuna fish? And she says, well, it was on sale and it's never going to spoil. And, but I guess in today's world, it's the Publix BOGO, right? Which, I mean, who hasn't fell victim to that, right? You buy two when you really only need one, but the other one's free. So you do it, you buy it, and maybe you didn't even really need it, but because it's like buy one, get one, right? Then you get the second one for free. That means like it's 50% off on the two. So much like the tuna fish that's on sale, you stock up on it. And Jack's joke on it was, well, that's fine, but nobody here at the house eats tuna fish, because we don't like tuna fish. But I think the story there is so true for what we need to be thinking about in terms of investing and looking at opportunities, because I think the tuna fish story is a great one that really underscores how human nature, how human behavior, how human psychology sort of differs between when it comes to buying a shirt, a sneaker, or tuna fish versus when we think about it as an investing opportunity. So to the extent you have some extra cash, we would simply leave you with the thought of it may be a good idea to go out and buy a few cans of tuna fish. Make sure you like tuna fish. Maybe you just get the chicken salad instead rather than the tuna, but you get the idea. Now, at the same point in time, I wouldn't necessarily back up the truck and buy every can of tuna fish at the store, right? That doesn't make sense either. But maybe buying a few cans of tuna fish makes sense in today's world. It's certainly an opportunity to invest money. When you look at the amount of cash that is sitting, that is on the sidelines, certainly there's a tremendous level of cash, much higher than where it was 2 or 3 years ago. I think we talked about that on a previous program. It's north of $1 trillion more than what it was pre-pandemic. That's an awful lot of money, still sitting, not making a whole heck of a lot. So maybe it might be time to go out and purchase some tuna fish along the way, right? So we thought that was a good story to kind of share on the program today. Also, remember the dollar cost averaging statistics, right? Those are some pretty strong numbers that ultimately really do go a long ways towards smoothing out the volatility of the market and also being an opportunity to ultimately get a return, even though the market may be flat going forward. So certainly some important things to be thinking about as it relates to your money and your investments and the opportunities that are out there. Look, there's always opportunities out there. It's a question of whether you're able to kind of take advantage of them on a consistent basis. Speaking of opportunities, if you've owned the dollar lately, right, and we all have because we should have a few of them in our wallets, the dollar is super strong. What does that all mean? We know that when we say that the dollar is strong, that its value relative to other currencies is at the highest level right now in over 20 years. But what does that really mean? What's the impact for investors? What's driving it higher in the first place? Well, when we return, we will talk about the strong dollar and what it means for you, your wallet, your investments, and maybe even has some kind of an impact on inflation as well. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the strong dollar, which has certainly been making a lot of headlines of late. See that in a lot of the conversation. We know that just generally speaking, if you have a strong dollar, that means the dollar, if you have a single dollar, buys more of a particular other country's currency. And that's kind of what that expression of the strong dollar means. The reality is that the level of strength of the U.S. dollar these days is at a record that we really haven't seen for 20 plus years. So in this segment, we're going to talk about what does that really mean, what's driving it higher, and sort of what's the impact on both households and investors. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's most listened to radio programs, coming to you on a host of podcast channels with over 25,000 downloads of our podcast, where we happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast platform, or you can even see the video of this program on YouTube. Have any trouble finding our channels, which are searchable by looking for Nelson Financial Planning or Dollars and Cents with Joel Garris, then go to our website, nelsonfinancialplanning.com, and there you will get directly connected, based upon the icons in the upper right-hand corner, to the particular platform of choice. Also on the website, you may want to check out our meet and greet luncheon that we're having on October 13th, where we're going to be talking about some of the best strategies to beat inflation in retirement. We're doing it as sort of a meet and greet for folks that maybe they wanted over the years to come in and visit with us, but just haven't really had the opportunity, or maybe were reluctant to share all of their information right out of the gate. This lunch is an opportunity to sort of get to know us, and also for us to share with you some of our strategies that we're using for our clients. So if you're on the website and interested in attending that lunch, make sure you also go to where you can register for that on our website. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So what does it mean to say when the dollar is strong? Well, as we said earlier, it essentially means that you can take $1 and buy more of another currency. So we'll look at a couple of different currencies real quick to see how that plays out. So the Japanese yen. A year ago, you could take $1 and buy 110 yen. Today, you could take $1 and buy 143 yen. That's how it kind of works. So that's about 30% more. So the reality is, if you were to all of a sudden jump on a plane, go over to Japan, your money would go about 30% more. I mean, you could buy 30% more stuff, if you will, as a result of how much more Japanese yen you can buy with that single dollar. Same thing happening in Europe today as well. Almost the dollar has the ability to buy €1. Previously, you had to spend like $1.50 to buy that same €1. So clearly, the dollars are going further. That's the concept of a strong dollar. So the reality is that why is that happening, to have the dollar be the strongest that it's been in 20 plus years against pretty much all of the major world currencies out there? Well, the reality is, and this may come as a little bit of a surprise, but the U.S. economy is in significantly better shape than most other economies out there on the global landscape, right? So I guess it's akin to having, the prettiest house on a pretty ugly street, but the reality is that our job market continues to be strong. Consumer spending continues to be strong. And as our Fed raises rates, and you have to be mindful of the fact that our Federal Reserve, our central bank, is raising rates at a much, much faster clip than many other central banks around the world. Other central banks are being far less aggressive on this inflation item. They're being much slower in terms of raising rates. Ours, on the other hand, clearly is raising rates at a much, much faster clip. And so far, economically, you still see decent job numbers, still see decent consumer spending, things like that. So ours is able to absorb, because our economy is generally in better shape, to absorb those higher interest rate increases, hence making us, I guess, the prettiest house on the ugly street that is most global economies these days that are overladen with debt, much like ours. Now, here's the real kicker, or I guess here's the real accelerant to that strong dollar. Because it's one of those things where if one thing happens and another thing happens and it just starts to kind of snowball. Well, you've definitely got a snowball impact happening as the Federal Reserve is raising interest rates. What's also happening is that the yield on the 10-year Treasury, so that longer-term U.S. government bond, is also jumping dramatically over the course of the past year. So a year ago, the yield on that 10-year Treasury was about 1.33. Today, right around 3.4, 3.5. Now, here's the thing. That's almost triple, right? So if you're an investor, or if you're a central bank or whatever, or your pension or whatever it is, okay, the reality is that it's still about return, right? I still want to have the best possible return as an investor. It doesn't matter where I'm at or what country I'm in. The reality is that I want the best possible return. So at the end of the day, why wouldn't you put more of your currency, whether it's yen, euro, whatever the case may be, into U.S. Treasuries, particularly because U.S. Treasuries are often thought of almost like a risk-free type of environment because it's backed by the U.S. government, full faith and credit of the U.S., taxing power, blah, 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 all that stuff. Generally, in terms of the investment landscape, U.S. government Treasury usually thought of almost like a risk-free type of return. I mean, that's how it's thought of. Okay, not sure I philosophically agree with that given the amount of debt, but that's where we are. Now, let's take a tour around the world. In Germany, their long-term treasury pays 1.75. In Japan, their long-term treasury bond would pay 0.25. So what do you want? You want 0.25, you want 1.75, or you want 3.4, 3.5? The answer seems pretty simple, right? I mean, I want to go where the return is the highest. So you've got more currencies flowing out of places like Europe, Asia. As more money flows into the U.S., well, guess what? Then the treasuries, the yields continue to rise even more. So that's sort of what's happening across the globe. Great if you're a tourist, for example, if you traveled internationally this summer, maybe over to Europe, you probably could have gotten the extra bottle of wine, the nicer bottle of wine because it was the same price as what it was a year ago because the dollar is much, much stronger. So beyond tourism and traveling internationally, though, there's some real implications for Americans and consumers right here at home, because it helps the U.S. consumer. A stronger dollar, if you take this to the next level, a stronger dollar helps the U.S. consumer by keeping a lid on import prices, right? Because then those have to go through that currency conversion, which effectively, if you keep a lid on import prices, then it effectively helps to push down inflation. Also important to note that it also keeps commodities in check as well. A strong dollar does, because if you think about oil, gold, etc., it's all traded in U.S. dollars. So the stronger that is, then the more it can push down the impact of inflation in those areas. So certainly something to think about in terms of that stronger dollar. Now, it's not all winners with a stronger dollar. The reality is if you're a large company that's very heavy on multinational business, then you're going to see your profits get squeezed a little bit. And by that, we mean we're talking about companies that ultimately do business all over the world. And generally, that's most large companies these days. So we're going to talk a little bit about the impact that the strong dollar has on corporate America, particularly global organizations, when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking a little bit on the program today about the strong dollar. What's it mean? What's its implications? How does it actually play out? In the previous segment, we talked a little bit about the fact that strong dollar means that dollar buys more of another country's currency, much more, in fact, in many cases, versus where it was a year ago. So what are some of the things that are helping to drive that? Well, at the end of the day, the Federal Reserve raising interest rates ultimately increases the yield on what treasuries are paying. Guess what? That means that if you're an investor, no matter where you're sitting, you want return. So more of those dollars are flocking to those types of investments that are paying a higher yield, certainly at 3.4%, 3.5% on the U.S. Treasury. That's a much better deal than Germany at 1.75 or Japan at 0.25. Where do you want to actually put your money? So that's sort of the dynamic that is happening. The positive side is because that keeps import prices in check, because the stronger dollar then buys more, particularly on the import side of things. Well, then that helps to dampen inflation. Haven't necessarily seen that much of an impact on that, but there has been a little bit of a dampening effect, thankfully. Otherwise, inflation would be even higher than where it is. The strong dollar also helps to kind of curb commodity prices as well, because oil, gold, things like that are denominated in U.S. dollars as well. So that's certainly the landscape in terms of the winners of the strong dollars, but there's also some losers, as with anything, right? There's winners, there's losers. So let's talk about the negative side of that strong dollar side, and particularly that plays out with large global companies, large multinational companies. And the reason that this concept is important is that if you look at the S&P 500, which is generally thought of as the 500 largest companies in America, what you'll find is that about 40% of the revenue that those companies make actually comes from outside this country. So this is definitely an issue to kind of keep an eye on and understand how it plays out and how it interrelates. The reality is, just to give you a couple of examples of the impact that that has, is the folks at McDonald's saw revenue fall by about 3% this summer from a year ago. That was largely due to the stronger dollar. Had the dollar been at the same level that it was a year ago, McDonald's, for example, would have had their revenue go up by about 3%. So there's definitely an impact that the strong dollar can have on multinational companies. Similarly, Microsoft suggested or made a statement that the change in the dollar reduced their revenue by almost $600 million just in the last quarter alone. So large companies have to kind of navigate the strong dollar and look for other ways to sort of offset costs, offset expenses, things like that. So that's one area where sort of the squeeze happens on a strong dollar. Similarly, the squeeze happens in the developing world, the emerging market world, because so many of those countries borrow money that is denominated in U.S. dollar terms, which means that when they pay it back, they have to use U.S. dollars to pay it back. So every time they're paying back their loan, if I'm a developing or emerging economy, I have to then take my currency, buy dollars, use those dollars to ultimately pay back the loan. So if the dollar is strong, that means I have to use more of my currency to buy the same number of dollars in order to make my loan payment. So that is where you see an impact, is on that developing world, emerging market type of economy. So bottom line with all of that, good, bad, indifferent, strong dollar, what should investors do? I would say, generally speaking, a strong dollar is more of a plus than a negative, right? More of a plus than a minus, particularly in its impact on pushing down inflation, right? Obviously, inflation really out of control right now. And so to the extent you can have anything happen that helps to kind of push that down by reducing import prices and commodity costs, then obviously that's, a good concept. As an investor, understand the impact, right? Not probably a great time to be loading up on emerging markets, developing markets. So you might want to really look at the component of your portfolio that is outside the U.S., more particularly, where is it outside the U.S.? Is it in a bunch of emerging market, developing markets types of things? And then similarly on large companies side of things, if you're a regular listener to the program, we're big fans of kind of following that large company approach. Those companies obviously have the power to be able to push inflation costs onto consumers, because at the end of the day, they generally will control the particular market that their product is getting sold, right? That's, after all, what made them a large company to begin with. So look more for maybe those companies that have a little bit more of a U.S. focus, less revenue from perhaps overseas. So those are certainly some tips that investors can be thinking about in terms of how to address this strong dollar. Certainly an important topic for folks to understand, and sort of what to watch for from an investment perspective. So that's sort of some information on strong dollar and what its implications are from an investor, from a retiree, and from a consumer. So anyway, welcome to the program. This, of course, is Dollars and Cents, Central Florida's most listened to radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So my name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So we're going to try and jam this in. Looks like we're kind of getting a little bit short on time, but we wanted to talk a little bit about something we teased at the beginning of the program, and that is this notion of if you think inflation is bad, wait till you see the ripple effect that it's going to have on your taxes for the year 2023 and potentially even for the year 2022, particularly if you collect Social Security. So we talked about this issue with our fellow certified financial fiduciary at Nelson Financial Planning, Rob Field, a couple of weeks ago about potentially an 8% increase in Social Security, and mentioned sort of this trap that exists before, but I think it bears repeating in a little bit further discussion in terms of kind of how ultimately it plays out. See, tax rates and your standard deduction on your tax return get expanded for inflation, but they don't use the same inflation index for adjusting the federal income tax rates as they do for Social Security. And right now, the rate of inflation that it applies to the federal tax rates, the chain CPI over the course of the past 12 months, is around 8%. Meanwhile, for the Social Security, which is indexed to the CPIW, the urban wage earners, that's closer to 9%. So your Social Security may go up a little bit more, but your tax rates aren't expanding as much to keep up with that, which thereby could push you more of that into a higher tax rate. So at the end of the day, yeah, tax rates are always expand, but they're expanding at a less of a rate as what Social Security is, thereby making more of your Social Security potentially subject to a higher income tax rate. Combined with the fact, and this is one that we've talked about for many years now, the threshold for which your Social Security gets taxed at has not changed in 30, almost 40 years. When they developed the thresholds that made Social Security taxable, guess what? They did not index them for inflation. So that means that more and more taxpayers are seeing their Social Security getting taxed. A little bit of a double whammy, if you will, in terms of how taxes and Social Security work together. That's all we got. We're going to wrap it up and get on out. Dollars and Cents, Joel Garris of Nelson Financial Planning.